We're glad to have you back. Now, President Bola Ahmed Tinubu has promised economic development despite the weight of social issues affecting majority of Nigerians. The president boldly put an end to petroleum subsidy and initiated what is seen to be a far-reaching reforms of the country's financial sector, starting with the central bank and its foreign exchange policy. In his first official trip as Nigeria's leader, the president attended the new Global Financing Pact Summit in Paris and have been relentlessly pushing for foreign direct investment. He has harnessed the power of strategic power of investment to address challenges of poverty, hunger, health, education, energy, climate change, of course, to propel the nation towards achieving United Nations ambitious sustainable development goals. To x-ray the president's drive towards achieving what seems to be impossible, but now looking possible, is an economic and investment analyst, Mr. Ayorinde Akinloye. He joins me via Zoom to talk more about this. Ayo, thank you so much. It's good to have you on the program this afternoon.
Good afternoon, Tolu. It's always a pleasure to be on the program. Thank you for having me once again.
Thank you so very much. It's good to see you. Let me start very quickly with you with the monetary policy issues. I think it's going to be interesting to start from that aspect. One thing that I know, Ayo, is that foreign investors want clarity, for transactions, for dealings with any country, and they will definitely bring their money when they are sure that they can also repatriate these funds. Moves made by President Tinubu shows that, yes, Nigeria is set for business. How does this come to you?
Okay, well, I think from a capital market point of view, so we have to look at it from two different perspectives, right? We have the capital market point of view, and that's basically talking about the financial market, so the equities market, the bonds market, which is where a lot of the foreign portfolio investors play. Because when you're talking about foreign investors, you have two categories of these investors. You have the foreign portfolio ones who are basically focused on coming to invest in our capital markets. They want to invest in our equity, in our stock markets. They want to buy our bonds and our government short-term fixed income instruments. On the other hand, you have the foreign direct investors who, what they're looking to do is to come in here to establish businesses, that would create employment, that would create job opportunities, that would, boost our economic growth, GDP, and basically, in some cases, drive even our export value. And, that contributes significantly to the overall economy, much more than what just you get from foreign portfolio investments. Now, by adjusting, by the move of the president, that's President Bola Ahmed Tinubu, to adjust the exchange rate level, basically to try and unify all the different windows that we have, the I&E window and all the other segmented windows that we've had. It's basically a move to try and attract foreign investors, to show foreign investors that we are ready for business. But which kind of investors will typically be attracted by this currency move? It's mainly the foreign portfolio investors. And even at that, from conversations with a lot of foreign portfolio investors, for a lot of them, this is still not really enough in terms of, for foreign portfolio investors, they either want to buy equities or they want to invest in fixed income. But when you go to our fixed income markets today, you look at interest rates, we are still operating at negative real return. So as an investor, if you're buying a 10-year bond today, you're actually going to be getting negative return. 10-year bond today is roughly around the 12 to 14% level, but we have inflation rates not towards of 23, 24%. So when investors are looking at that, they still believe that for us to see a massive influx of foreign portfolio investors as a result of the tweaking, the exchange rates regime, there is still need for interest rates to actually catch up with and even gallop beyond the inflation for investors to be attracted to now flow in capital. Yes, by devaluing the currency, we basically have valued the naira at what foreign investors would consider is the fair value of the naira. That is one part of solving the problem. But there are still other dimensions. And like the first one that I mentioned is on the interest rate side of things. Now, the second thing you also have to consider is when you if you look at what we have done with our exchange rates, it's basically more like a technical devaluation. And I'll give you the reason why. For example, in the R&E window, we have the dollar doing roughly about 750, 770 at the R&E window. But agencies of governments are not operating at that exchange rate. So, for example, at customs, we read that they are going to adjust the exchange rate for recognizing duties and tax payments to 590 to $1. So you can see that even government agencies are not operating at the so-called defined unified exchange rate. So in some ways, you can still say that we still have some sort of segmented exchange rate practices, which if in all truth, if we are going to say we are unifying the exchange rate system, everybody in the economy, must be operating at that singular exchange rate that is dictated by. Then also, you can't have certain commodities being exempted from the exchange rate market. So, for example, when the CBN announced the new exchange rate policy, they mentioned the fact that the previous about 40 plus items that were previously exempted from the R&E window are still exempted till now. Automatically, by exempting those items from the R&E window, you are still creating a black market whereby those items that don't have access to FX from the R&E window, we go to the parallel markets to source their FX needs for whatever they need to import. So if we want to unify the FX, the exchange rate market, we need to do that true and true. So for me, it looks like the federal government has basically implemented a technical devaluation of the currency, because you still have government agencies operating at a different FX level. Customs at 590, NMPC is yet to reflect the impact of the devaluation on PMS prices, because if NMPC is operating at the I&E window exchange rates, then we should have actually seen an upward adjustment in PMS prices also. On the other, also, you have items that are still exempted from accessing the I&E window, and automatically you are creating a parallel market for that. So basically, there's still a bit of lack of clarity around that for investors. So more is still needed on that front. So that is, I've mentioned the interest rate issue, and I've mentioned the fact that even the exchange rate policy adjustments itself still requires a lot of work for it to be totally clear to investors. Now, the third thing is for investors to flow in funds, like you mentioned, they need to have that sort of guarantee and assurance that by the time they want to repatriate their funds, which is very typical for foreign portfolio investors who typically would have a very short time investment horizon within the economy. By the time they want to repatriate their funds, maybe in the next 1 year, they want to have assurance that there's going to be enough FX liquidity for them to be able to get their dollars back and repatriate their funds. But the truth is, for there to be improvement in FX liquidity, we know that there are still fundamental issues we need to address in terms of improving our export earning capacity, which would impact our external reserves and would ultimately boost FX liquidity. The singular decision of technically devaluing the naira or trying to tweak the FX policy or the FX regime is not going to be enough to boost liquidity within the FX market. It's been roughly about 2 weeks or so since we've seen the new Forex policy. And it's going to be interesting to continue to watch the level of liquidity within the I&E window and the broad FX market at large as we go over the coming weeks. Because I strongly doubt that we are going to see a significant spike in FX liquidity within the economy simply because of this decision. The fundamental issue of being able to generate export proceeds and generate FX would need to be addressed. So those are just some of my issues. Some of the issues that I feel still needs to be addressed in order for us to really see, the full enthusiasm of foreign investors within the country. And that is even besides talking about how it affects foreign direct investments, because that requires much more than just policy, FX policy. There are other issues regarding the economy and things like that, which we'll probably delve into as we continue the conversation.
So IMF, World Bank, AFDB are already commending the president on this move, But like I agree with you, those are just basic fundamentals that has to do with the market that you've highlighted there that needs to be addressed. But moving forward very, very quickly, I'm still going to follow up with liquidity in that market remains very important, having more funds to go around. Now, what more can be done? So we open our eyes to the discussion that should come around that table that can help improve liquidity in the FX market. One way or the other, we need to improve that. So what do you think, or what in your suggestion can help us drive that? Of course, non-oil exports will be one of it, but what more can we look at?
Well, I think it's not far-fetched in terms of saying what do we need to do to boost FX liquidity. Basically, dollars is not the currency we spend in the Nigerian economy today, right? So if you need dollars, you need to earn dollars from the international market. Now, how will the international market give you dollars? You need to offer goods and services to them. So if you have quality goods and services that are in demand in the international market, you get value for whatever product or service you offer to the international market. So basically, if we are going to improve FX liquidity within the Nigerian market such that it will be sustainable and it would last long, we need to improve our export earning capacity. That is the bottom line of everything regarding the FX market. Until we're able to do that, you know, it's very easy for us to, we go back to history, right? 2015, 2016, pre-2014, you know, we had adequate FX within the Nigerian economy. For a long while, the exchange rate was about 150, 155 naira to a dollar, you know, that period, pre-2014 levels, before we started to see, you know, crude oil production was being affected, and as a result, our crude oil earnings started to decline. And with our crude oil earnings, with FX crude oil production being impacted, crude oil prices started to come down again in 2015, 2016, you know, after the flooding of the markets with US shale oil and things like that, and all the developments around the oil market at that time. Suddenly, our FX earnings plummeted significantly because we're focused mainly, our main FX source, you know, was our crude oil. Today, our crude oil production is roughly about 1.2 million barrels per day, as at from where we speak today. About 7 years ago, plus 9 years ago, we're doing roughly 2 million barrels per day. That is a significant decline in our export earning capacity from oil. But the truth is, we can't continue to rely on oil, even though there is a quick win there. When I say there's a quick win, what do I mean? Currently, why is our crude oil production almost half of what it used to be years ago? Insecurity challenges across a lot of our pipeline infrastructure and terminal infrastructure by which we export our crude oil. The critical thing that I think we need to do is first immediately arrest oil theft. How can we curb oil theft? What is the whole mechanism around the oil theft problem that we currently have in the Nigerian economy? How do we get rid of that? How do we bring all the perpetrators to book? And how do we ensure that we get value for all the crude that we produce from the different oil fields, and we get our production back to the highest level possible? Automatically, you can imagine if we increase our crude oil production from 1.2 million barrels today to 1.8 million barrels, although we have the OPEC plus quota there that we still have to deal with. But even taking that out, if we are producing 1.8 million barrels, that is extra 600,000 barrels of crude oil that will be produced daily within the country. You can imagine how much that would come, how much of FX will come into the economy just by that singular action. That is one way we can sort of at least immediately drive FX liquidity and improve our export earnings. Now, away from that, the second thing is, how can we work on the business environment such that we have patient capital that will come into the country? In the first exchange that we had regarding, you know, the FX policy, right? I mentioned that we have foreign direct investments, we have foreign portfolio investments. If you are going to have long-term patient capital within the Nigerian economy, we need foreign direct investments. But foreign direct investments will not come if, number one, the financial markets remain structurally defective and the overall economy and business environment also remains defective. So we need to have targeted policies at specific sectors that we know that investors are interested in investing in within the Nigerian economy, in order for us to be able to attract more patient FX. You know, when these FX are coming, when they are coming in, they are not, you know, they are not foreign portfolio investments that come and go, you know, basically out money within the space of 1 year and all. And once there's policy normalization in developed economies, those funds begin to leave the economy. So we need to look at how we can attract stable foreign direct investments. And the third thing is, you know, the other thing that non-oil exports, like you mentioned, Non-oil exports is non-negotiable. We need to look at our agriculture. We need to look at mining. These are long-term issues that we need to solve. We've delayed solving these issues for 10 years, for 20 years, and we continue to rely on crude oil. And we are basically paying the price now for things that we should have done several years ago. If today Nigeria is among the biggest exporters of palm oil, of mineral resources, of soybean, of cashew nuts, of sesame seeds, and all these different agricultural items, we won't be in the situation we find ourselves today. We would have adequate effects. People talk about either floating the naira or having a managed float. Countries like China, for example, Saudi Arabia, what exchange rate regime do they practice? They practice a managed float regime, the same exchange rate regime that we practice in Nigeria. But their currencies are much more stable than the Nigerian naira. Why? Because they have a strong export base. They are able to export a lot. They earn a lot of foreign currency. So the government and the CBN, their banking authority, there is able to defend the currency. And, China sometimes even decides to devalue their currency just on their own volition, because they don't have to devalue. They just decide to do that when they feel that their currency is becoming too strong. So what we need to do as a country is to achieve a level where we earn adequate export earnings, such that no matter the demand for dollars that we have within the economy, we know that with our export earnings, we'll be able to earn more than enough to take care of our local demand and also boost our external reserves, and we're able to save for the rainy day. So when we are talking about solving FX liquidity problem, it is about solving our ability to earn from export revenue. Until we get that right, we will continue to go in these circles of devaluation. In 2017, we devalued the naira. We saw a bit of stability after a new window was introduced and everything was looking good. And then 2 years later, we came back to the same point again. And we devalued the currency further. We saw improvements in liquidity, and we are back to the same point again. And I assure you that in another 1 to 2 years, we would be back to the same point again, having the same conversation, unless we address the long-term issues we are failed to address.
In 1 minute, Ayo, I hope this is possible for you to wrap up in 1 minute. But I'm thinking, what kind of interventions do you expect from government at this time? Because, of course, like they say, pain, was go through some pain before we gain. No pain, no gain. So just interventions.
Yes, basically, so basically, quickly, I think in terms of interventions, I think the first key thing is to look at the agricultural space. Who are the biggest players within the agricultural space that are already driving export earnings for the Nigerian economy today? If you look at our trade data, we export quite a lot of agricultural commodities, nevertheless. So who are the players behind these things? How do expand capacity? It's a scheme, Anchor's Bora program and things like that, and just disbursing funds randomly. It's about targeting intervention. Let us look at each of these key sectors that can drive our export earnings. You go to the mineral resources sector, that's the mining sector. Who are the players there that are currently creating value within those sectors? How can we support them? What policies do they need for them to be able to expand scale, double their capacity within the next 1 year, double their capacity triple their capacity in the next 3 years, so that we can double and triple our export earnings? They can pay more taxes to the government. And then we do targeted interventions to these particular companies and players that are actually driving, those systems. We've done it in the telecom sector with the likes of MTN, Glo, more than 20 years ago, and we saw the results that delivered. Can we repeat something like that in other sectors? Then, apart from targeted interventions, the other thing is, how can we look at our fiscal management in terms of the fiscal policy of the government, budget, spending, curbing fiscal wastages and other excessive spending within the government? How can we drive efficiency such that all the resources government has is able to go to key infrastructure that would ease the business environment and make business easier to do? So those are the key things that I think are quick wins that government can look at implementing, and we would begin to see the results in no short time.
Ayorinde Akinloye, thank you so much for your time on the show. This holiday economic and investment analyst. Enjoy the rest of your day.
Thank you very much for having me, Tolu.